This leads us to our talk of the tape. Do you stick with what's been working heading into the new year, or is it time to readjust and reposition? So joining me now to discuss all of this is Citi's U.S. equity strategist, Scott Chronert. Scott, we've been talking a lot about the kind of maybe lowish volume, kind of waiting, holding pattern type situation we're seeing today. It's not all uncommon after the day after Christmas, but This does beg the question about whether or not the same storylines hold in 2026 as they did in 2025, at least for the first half, Scott, of 2026.
Yeah, Dom, I think there's a good argument that it will. Our approach is that we think it's going to be a little bit different. We're using the word idiosyncratic to describe how we think the setup into next year goes. So we're looking for broadening into other sectors. We recently upgraded healthcare alongside ongoing overweights in banks and tech. But we also got a little bit more constructive on the industrial sector as well. And in addition, I'd say we've also gotten more positive on the outlook down cap in the U.S. small mid. So we think the setup for next year is going to be consistent of a number of these Elite 8 names and the AI influence stocks continuing to differentiate, but with a broadening dynamic out the spectrum that we think is going to be ultimately the path to double-digit gains for next year.
So double-digit is what you're expecting right now. Your forecast currently sits, Scott, I believe, just around 7,700. So if you look at the S&P right now, 6,930, that's a roughly 10, 11% gain from current levels. Just how much on that sliding scale will the contribution be from those Magnificent 7, Elite 8 type names, as you point out, versus the rest of that 493?
Well, it's a really good question. The way we're addressing this, I get asked the question a lot, do you think we'll see ongoing leadership out of that Mag 7 Elite 8? Our response is we have to get at least participation. I don't think we need to get leadership, but if we can get in aggregate, courtesy of stock selection within it, that part of the market moving up, let's call it 40% of the index, up in the double-digit range, and then that marries with this broadening playbook that we're talking about, you can still get there. But the bottom line is you need to think about this index in sort of a 60-40 lens, where you've got the 40% of the index you can attribute to the AI Elite 8 playbook, and then the other 60% that's going to be representative of this broadening thesis, including productivity gains coming out of increased usage from AI. So the bottom line here, Dom, is that we think it's going to require a combination of forces to lift the index next year. We think it's pretty doable based on what we see unfolding from a fundamental perspective.
You know, it's interesting as well because many of the value-oriented sectors that we talk about often, thinking about names like in materials or in energy or in real estate, utilities, if you look at the weight of those sectors, mathematically speaking, they're roughly the same size as, say, the industrials or the healthcare sector, maybe a little bit bigger than industrials, a little less than healthcare. But that math still is formidable, right, in terms of what they have to do, in terms of what they have to do actually to get that kind of performance driver. How much of that is going to be driven, in your mind, by, say, earnings growth and the macro factors around propelling profit growth versus, say, some of the multiple expansion that we might see as people decide to take on perhaps more risk?
You're spot on with this. So look, we're differentiating with a fairly aggressive 320 estimate for index earnings next year. That puts us at the high end of sell-side strategists. Off of the last 2 weeks price action and fundamental follow-through on some of the companies that reported since, we're up to 313 now. But what I would say on this is that there's no question, if you step back and look at the playbook for this year, this is really interesting. The only part of the index, call it the Elite 8, the Mag 7, that has earnings estimates for 25 higher than where we started the year is there. Everything else got stepped back around April's tariff talk and is still working its way back to that early 25 starting point. So you see where this goes from our perspective. You continue to get the growth expectations that we think are there for the AI related, and we suspect they'll deliver. But it's this broadening playbook into other more traditionally economic sensitive sectors and some that are not so. For healthcare, as an example, you combine that with financials, you throw industrials in. Now, we're underweight consumer, but we think there's still room for that to come back later into 2026. All told, what you get is this shifting fundamental paradigm that's really relying on sort of a Goldilocks economic circumstance and this onward downward trajectory in terms of where Fed funds are going.